Hi, myself Aarti, Assistant Professor, Department of Commerce with Information Technology, working in Dr. SNS Rajalakshmi College of Arts and Science, Coimbatore. So, I am here to take a topic on cost concepts in economics. So, here, cost concepts in economics refers to the value of resources and efforts that is sacrificed to produce a goods or a services that are measured in monetary terms. So, here it is a foundation principle that will help us to find out the businesses to understand their production expenses and to make the information decisions about the pricing, resources allocation and profitability. So this is all the basic concepts of cost concepts. So here there are different aspects of cost concept. The one first thing is that sacrifice and foregoing. So here the cost that represents the value of what a firm gives up, like it can be a resources or it can be a time or it can be any other opportunities to achieve its production objectives. Next we have monetary value. So here the cost are typically the expression in terms of money, allowing for easy comparison and analysis, that is known as monetary value. So here we have different types of cost concepts. So now I want to have a question like what is important in business. So in cost concepts, so we have to understand the cost concept is crucial for businesses. So why is because it is to determine the floor of pricing their product or services. Next we have to have a informed decision about the resources that we are allocating and the investment that we have done. Third thing is that we have to assess the profitability of different production process. So this is important in business for understanding the cost concepts. So there are different types of cost concepts. So first we have the fixed cost. As we all know, fixed cost is the cost that remains constant regardless in the level of production. For example, rent, insurance that we pay. So next is the variable cost. As we all know, the name itself differs variable. The cost will that keeps on changing with the level of production. So here if you take an example, a best example is your raw materials. So when you want to produce a product, you buy a raw materials. At the time of demand, when you buy a raw materials, the raw materials price would be higher compared to the previous. So such things are the variable cost that incurs in the factor of production. So next we have the indirect cost. So here indirect cost are the costs that cannot be directly tracked at a specific product or services. So example, it can be rent or it can be any utilities that has been done. So this flow of money cannot be come directly into the transactions, that cannot be tracked easily. So next we have direct cost. So here the name itself differs, a cost that can directly track for the specific product or services. So it can be a raw materials for a specific product, so you can track each and every cost that is incurred. That is known as direct cost, whereas in indirect cost you cannot directly track for the specific product or services the expenses that you have done. Next we have the total cost. So total cost is the total expenses that is incurred to produce a product. So the total cost can be the cost per unit or the quality that are being produced. So here the total costs will incur the total fixed cost and the total variable cost. So here the total cost is the cost which is incurred by the producer to produce a particular quantity of the commodity. Next we have the average cost. Here, the average cost is the expenses incurred by the producer for producing each unit of the product. So, here the average cost is the per unit expenditure for the producer. So, average cost can be like average fixed cost plus average variable cost. So, here the average cost can be found for per unit of quantity that is being produced. Next, we have marginal cost. So, marginal cost is the expenses incurred by the producer to produce an additional or an extra unit of the commodity. So, here the marginal cost is the incurred additional cost that for producing one extra unit for a certain amount of units. So, marginal costs are the cost or expenses. So, next we have the opportunity cost. Here, opportunity cost is the opportunity or choice that is left for the based on the sacrification or an alternative choice. So here this opportunity cost is a foregone production factor in a business for a alternative production factors. So here it is an option or a factor of production for an alternative option or an alternative factor of production, that is known as opportunity cost. So this is all about the cost concepts. Thank you.